Every single day, the news tells you the market went up or the market went down, as if it were a living creature with a mood. Trillions of dollars move. Fortunes are built and destroyed. Your parents' retirement, the richest people alive, the headlines, all tied to this thing called the stock market. And yet, if I stopped you on the street and asked a simple question, what is a stock actually, and when you buy one, what do you really own, most people couldn't tell you. They either pour their money in without understanding it, or they're too intimidated to go anywhere near it. Both are a problem, because over a lifetime, this is one of the single biggest factors in whether ordinary people build real wealth or never do. So let's strip away the jargon and the flashing numbers and answer the questions that actually matter. In plain English, what is the stock market? How does it really work? And how do normal people make and lose money in it? Let's start at the very bottom. A stock, also called a share, is simply a tiny piece of ownership in a real company. That's it. If a company is sliced into, say, 1,000,000 little pieces, and you buy one of those pieces, you now own 1/1,000,000th of that entire business. Its buildings, its brand, its future profits. You are not lending the company money the way you would with a bank. You are literally a part owner. As a shareholder, you're entitled to a slice of the profits, and usually a vote on the big decisions. Now, why would a company do this? Why chop itself up and sell off the pieces? Because it's a way to raise an enormous amount of money. When a company first sells its shares to the public in an event called an IPO, an initial public offering, it can raise millions or even billions of dollars to grow. Money it never has to pay back like a loan. In exchange, it gives up a piece of ownership to thousands of strangers. So at its heart, the stock market is just a giant marketplace where people buy and sell these little slices of companies all day, every day. So why does a stock price jump around every single second? Here's the key idea most people miss. A stock's price isn't handed down by some official. It is set by a constant live auction between buyers and sellers, exactly like an open street market. If more people want to buy a slice than sell it, the price ticks up. If more people want to sell, it ticks down. Simple supply and demand. But here's the subtle part. What people are really betting on is the future. A stock price reflects what the crowd collectively believes the company will be worth and will earn years from now. That's why a company can lose money today and still have a soaring stock if investors believe huge profits are coming. And it's why good news that's merely a little less good than expected can send a price crashing. The market isn't pricing reality. It's pricing expectations about reality. The legendary investor Benjamin Graham put it perfectly. In the short run, the market is a voting machine, driven by emotion, hype, and fear. But in the long run, it's a weighing machine that eventually settles on what a company's genuinely worth. Day to day, it's a popularity contest. Over the years, the truth tends to win out. Okay, so how do you actually make money owning these slices? There are two ways, and really only two. The first is the price going up. You buy a share, the company grows and becomes more valuable over time, and the slice you own is worth more than you paid for it. Sell it, and that difference is your profit, what's called a capital gain. The second is dividends. Many established companies hand out a portion of their profits to shareholders every few months, simply for owning the stock. Money that shows up while you do nothing at all. But here's the part worth burning into your memory. The real magic isn't any single hot stock. It's the long game. Historically, the U.S. stock market as a whole has returned around 10% a year on average, measured over decades. That doesn't sound dramatic until you combine it with compound interest from our earlier episode. Money left invested for 30 or 40 years doesn't just add up, it snowballs. A modest sum, left alone in the broad market for a working lifetime, has historically grown into a genuinely life-changing amount. Not through clever trades, through patience. Now, the part that's worth arguing about in the comments, and it might just be the most useful thing in this entire video. Most people who try to get rich in the stock market actually end up making themselves poorer. Here's why. The fantasy is to pick the next winning company. or to buy low and sell high by timing the market perfectly. The reality is that this is staggeringly hard, so hard that the overwhelming majority of highly paid professional fund managers, with whole teams and supercomputers, fail to beat the simple market average over the long run. If they can't reliably do it, the odds that you, trading on your phone during your lunch break, are honestly not good. Every trade you make racks up fees and taxes, and worse, it invites emotion. Buying when everything feels euphoric and prices are high, then panic selling when everything feels terrifying and prices are low. The exact opposite of what actually works. So here's the uncomfortable secret the financial industry isn't eager to shout from the rooftops. For most ordinary people, the smartest move is also the most boring one. Don't try to be a genius. Just buy a tiny slice of the entire market through a low-cost fund, and then, crucially, leave it alone for decades. The person who quietly does nothing usually beats the person frantically trading. We'll cover exactly how to do that next time. But the principle is this: in investing, activity is very often the enemy of returns. Of course, none of this is free money, because the market goes down too, sometimes violently. In 2008, the US market lost more than half of its value. In early 2020, when the pandemic hit, it fell by about a third in a matter of weeks. If you had your life savings sitting in there and watched the number get cut in half, it is genuinely terrifying. So here's the honest truth about risk. In the short term, the stock market can be brutal and completely unpredictable, and you can absolutely lose money, especially money you might need soon. But here is the pattern that history keeps repeating. Every single crash so far has eventually been followed by a recovery to new highs, given enough time. The people who got truly wiped out were usually the ones who panicked and sold at the very bottom, or who were forced to pull their money out at the worst possible moment. The people who simply held on and kept calmly investing through the fear, recovered, and then some. There's a saying that captures it: time in the market beats timing the market. The real danger was never the roller coaster itself. It's jumping off at the scariest part of the ride. Let's land the plane. 3 things to take with you. 1. A stock is a real slice of ownership in a real company. And the stock market is just the place where those slices are bought and sold. 2. Prices move on expectations about the future, a voting machine in the short run, a weighing machine in the long run. 3. For most people, wealth in the market is built not by clever trading, but by owning a broad slice of it cheaply and holding on through the storms. And one last thing worth remembering: the stock market is not the same thing as the economy. The market can hit record highs while ordinary people are struggling, because it runs on the expected future profits of big companies, not on how your week is going. So the next time you hear that the market hit an all-time high, you'll know what that does and doesn't actually tell you. Next time, we'll answer the obvious follow-up question. If simply owning the whole market is the smart move, how on earth do you actually do that? The answer is a clever little invention called an ETF. Subscribe to Plain Economics. No jargon, just plain.